Agarwal and find out what he's making of the year gone by and what 2026 may have in store for us. Ashwini, hi, morning. Good to have you on the show. Ashwini, we often keep talking about here on the ET Now newsroom as to how flat the year has been for the Nifty. And, the stark underperformance, of course, from the mid and the small caps. That's been the highlight of the year gone by, right? Especially the latter part. How much of it could change, Ashwini, as we step into the new year?
Morning, Aisha. Thanks for having me here. I think it's a great question. And, my mind travels back to September of 1994 when the markets had made a high of, with the BSE Sensex at 4,200. Stocks were quite expensive, and we were all very young greenhorns, and we would put out reports with price targets at 20 times price to earnings multiples. And the next, 3 to 4 years are very challenging because the economy went through a significant, squeeze because a lot of the NBFCs went out of business, liquidity remained tight. There was a Russian crisis and the Asian crisis during that time. The point that I'm trying to make is that, while 1 year seems like a very long period of flat returns, history tells us that this could be much longer. And the reason to my mind is that earnings growth is still elusive. We are all hoping that fiscal 27 will see some improvement in earnings growth with all the cuts in GST that have been put through with easing of liquidity that's happened. But at the same time, there are imponderables out there, which include, continuing weakness in the INR if gold and silver continue to appreciate, and potential one-off risks from overseas for investor sentiment if all this AI bubble starts deflating. AI is here to stay, I have no doubt in that, but a lot of the investment that's being made is probably not going to bear fruit. And that, I think, will be painful for stock prices. Now, whether that will happen in 26 or 27 or 28, I have no idea. But we are looking at risks out there. And at the same time, there is hope that earnings growth will revive. And in several cases, stocks are down 50, 60% from the highs that we saw a year ago. So on a bottom-up basis, there are opportunities, but on a broad market basis, I think I wouldn't be terribly surprised if we saw another year of +5, -5 and ended up nowhere.
How do you protect capital then, Ashwini, in the year ahead?
Asset allocation, I think, is the only way one protects capital. So you have a mix of equity, you have a mix of debt, you have some exposure to commodities, metals, and some real estate, then that's the only way to go. One of the most underappreciated asset classes that has come into the Indian markets over the last 6, 7 years is the REITs. And I don't know how many retail investors have looked at this asset class closely. But it's a very good combination of some growth with some yield, and it tends to protect value. So, and then you have, of course, the metals rally, which is essentially a weak US dollar trade. So you have to put these into the portfolio mix. So, that's how you protect value. And the other way to protect value is to go bottom up stock select, attempt bottom up investing if they are not full-time professionals who are in the business of investing. So that's going to be a tricky one. But I think asset allocation is the real key in my view.
Ashwini, hi, morning. This is Harsh here. What is it going to take for you to likely change your opinion? Is it going to be faster earnings growth, which will surprise you, in your opinion? And I'm talking broader markets here. You've spoken about bottom-up stories where there are opportunities, and I'll come to that. But with regard to the larger market, will it be an earnings revival which will likely drive your conviction, if at all that were to play through? And if so, what will it be to surprise you?
So two things. I'm looking for earnings growth improvement. So if the earnings momentum starts to improve, let's say in December and then following in March, and we start to see a trend of stronger earnings emerge, I think that would be something I would welcome. The other thing that we need is the INR to stabilize. Now, for that, I think one of the elements that we need to see is to see the precious metal prices, the gold and silver, stabilize. The INR weakness is a huge negative for foreign inflows. People invest in emerging markets so that they may make money. And what they don't want to do is make money in the underlying stocks or the underlying economy, but lose it all on the FX. So I think we need stabilization of the INR and we need earnings growth to emerge. You need both of these to happen for me to change my view, and it can happen. I mean, both these factors are possible. I mean, as if let's say over the next 2 to 3 months, we all come to the firm conclusion that the rupee is now going to be stable for the next 1 or 2 years. So whatever factors might emerge, it might be weaker crude, it might be finally the U.S. trade deal being signed. There could be a host of factors which lead us to believe in that. So that I think would be positive for foreign inflows. That would be encouraging. And what you would need is an emergence of earnings growth for the broader market.
But I mean, and correct me if I'm wrong here, Ashwini, I don't think there is dearth of FII money here. Look at the IPO subscription, look at the blocks. I mean, money is there. There is enough liquidity buying India. It's just buying it through other means, right? And do you sense that this could continue very well into the new year? You've got some very large IPOs in the pipeline for the next year too.
Yes, see, the IPOs will continue, and some of these IPOs are large and good quality offerings, and which investors are interested in, and rightly so. But what's happening, Aisha, is that they're being financed by selling down of existing holdings. So fresh new capital from foreign sources is quite limited. Again, even if you take private equity into account, you have to net out what they're taking out and then see what are the fresh inflows. I think commitments are there. I think the interest is there. But I think valuations and lack of earnings growth, as well as a weak INR, have been dampeners. So if these factors correct, then I think you will see a lot of positive momentum. For the moment, I think IPOs will continue. For the IPOs party to end, we need a spectacular IPO to go terribly wrong. I mean, every bull market ends with a large IPO, not making any money for investors and dampening the sentiment. I haven't seen that till now. There have been a couple of IPOs that haven't done so well. And of late, if you see the percentage of IPOs that are in the green, say 3 or 4 weeks from the listing date, are declining. But I think the sentiment hasn't broken yet. So I think the IPO party continues for the time being.
Yeah, and Ashwini, you were talking about those bottom-up stories. Do you think that's what's
Yes.
at play when it comes to IT largely? Or do you sense some sector tailwinds in place now, other than the rupee?
So, one of the things that I've been wondering about in IT is that is the use case for AI for IT services in particular underappreciated? What I mean is not that they'll help clients implement AI as a service offering, which obviously they will. But I think there's an opportunity for IT services to take out costs using AI, especially at the bottom of the employee pyramid. And I think that might be something which is underappreciated. And let's see how this evolves. This is just a thought at my end for the moment. I'm not playing it, but this is a possibility because they're putting a lot of effort into training AI engines within for the projects that they're implementing for their clients. And I think one outcome of this could be that margins improve even if sales growth remains fairly slow, or billable hours remain fairly slow. So what you might see is margin improvement or margin lift coming out of AI for IT services. I mean, that can happen.
Uh, Ashwini, you've run money through multiple cycles, right?
Yes.
Give us a sense of what investors are underestimating in terms of the 3 to 5 year risk, because you are one of the few people who are actually cautious with regard to Indian markets. So give us that sense.
One of the things that really worries me is that from 2008 on, we've had this huge desire on parts of central banks and governments across the world to lift up equity markets. And you've seen real rates being close to zero or being in negative territory in large parts of the world, with financing which is not sustainable. I don't know how this bubble will burst, but it will. It's not sustainable in my view. It's not sustainable for everyone to keep printing money and nominal prices of assets keep going up and all of that debt accumulating on central bank balance sheets and in fiscal deficits. So this is not sustainable. The second thing is that what's happened in the US with the reset of free trade is that most economies have started looking inward, which will affect productivity across the world. Some of this will be offset by AI gains, but some of this will be lost. And I think a combination of these two factors can lead to accidents that we can't comprehend or at least forecast at this point. This is similar to what happened in the Asian crisis or the ruble crisis, and this is something that we saw in about a decade ago when Portugal, Italy, and so on and so forth went through a major crisis. So these are imbalances. We have to be aware about them, and that is why I say that asset allocation is the only way to protect your wealth, where at least some part of your portfolio gives you some yield, gives you some positive returns even if equities don't do well. And the other way to go about it is to have some cash. I would recommend that investors that depend upon market to run their households should have at least a year's of expense or 2 years of expenses, in a savings bank account, so that you can ride through a bear cycle without a problem.
Okay. Ashwini, what are the pocket spaces? And I know you're looking at this more from a bottom-up perspective, but bottom-up, what are the pocket spaces that you're liking? Is it Indian manufacturing? And where is it that you're finding risk-reward favorable?
So, I'd spoken about this earlier as well. There's several stocks which are down 50-60% from their recent peaks, and where, balance sheets are in good order and managements are trying to drive earnings growth. On a bottom-up basis, some of them appear quite reasonable to me. Some of these are in the financial services space. Some of these are, smaller banks. Some of these are Indian manufacturing, some of them are consumer facing companies. It's across the board. And one of the things which is different this time from the way I think about it is that in the past, whenever I've looked at the market, at least in the last 20-25 years, there's been a sectoral tilt to the market. Some sectors do well, other sectors don't do well, and you can find the reasons. This time around, I'm seeing significant disparities in valuations and growth outlook within the sector. So this is not a sector theme driven market to my mind. Gold, silver, metals might be an exception where some thematic play might be there. But otherwise, I would say that there are a lot of bottom-up opportunities within sectors because the derating has been quite extreme in some situations. So, that's what I'm focusing on. I'm looking at stocks which are trading at well below their long-term median valuations, whether be it price to revenue, price to earnings, EV to EBITDA. You can take the pick. And a reasonable investment thesis says that, well, they should return to long-term medians at some point over the next 2 to 3 years. And if there's some earnings growth along with that, you can make a quite a reasonable return. That's how I'm investing.
Okay, Ashwini, great to have you on the show. And here's wishing you a happy new year from all of us.